NVIDIA recently announced that they are going to split their stock 10 for 1. So what in the world does that mean? What is a stock split? How is it going to impact you as a shareholder or a potential shareholder? That's what I'm going to dig into today. Give you everything you need to know, including the date you will actually see one share turn into 10 shares. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. The first thing to know about a stock split is that it's really just how many pieces a company is divided into. It doesn't really matter whether a company has 10 shares or 10 billion shares. What matters is what percentage of the company you own. From a technical perspective and from an economic perspective, nothing is going to change between owning one share before the split and 10 shares after the split. Now, that doesn't mean that there isn't an impact on the market. And the two ways the stock splits typically impact the market is psychological and from a liquidity perspective. So that's the angle that I'm going to look at this today. But let's get to the details of this exact split. This is the earnings release from last week, giving the exact details behind the stock split. Now, they set up here 10 for 1 forward stock split effective June 7th, 2024. Now, the other important details are right here, because the strange thing with trading in the stock market is that not everything happens instantaneously. There's actually a lag between an event happening and when you actually see that event trading in the market. And that's because of what they call settlement. There's a settlement times in the stock market. So they say that each record holder of a common stock as of Thursday, June 6th, that's this coming Thursday, will receive 9 additional shares of common stock. That's the 1 for 10 stock split. As a result, those 10 shares will likely be worth about 1/10 of what the price is at the close of trading on Thursday. Give or take a little bit, but that's typically how these things work. They will be distributed after the market closes on Friday, June 7th, and then trading is expected to commence on a split adjusted basis on Monday. So basically, they're going to take a look at who owns shares at the close of trading on Thursday. Those shares will be adjusted based on that record, that date of record is what they call it. And then ultimately, those shares will begin trading on a 10 for 1 basis on Monday. So you won't see that adjustment happen on Friday to the number of shares and to the price of NVIDIA stock. You're actually going to see that take place on Monday. It's a little bit confusing how this works. And actually, if you own shares or if you're even trading shares on Thursday, Friday, or Monday, all of this will happen in the background. It's not something that you need to actively do. It's not something that there's going to be an advantage of buying shares on Thursday and selling on Friday, or selling on Thursday and buying on Friday. None of that is really going to matter long term, and there's not going to be a huge arbitrage around this stock split either. But these dates and these moments in time are the mechanics behind the split actually happening. So by the end of next week, NVIDIA will be trading at more like $110 per share rather than $1,100 per share. So why in the world is NVIDIA splitting its stock? Well, there's actually a few reasons from a market perspective. The first reason the companies like to split their stock is because it's just psychologically feels a little bit better for investors to own round numbers of shares and own more shares of stock rather than having that stock be at a higher price. If you own one share of NVIDIA stock at $1,100 or 10 shares of stock at $110 after the split, there's no difference in what you actually own in the company. But that doesn't mean that it doesn't feel a little bit better to say, hey, I own 10 shares of NVIDIA stock. Sam Walton talked about this when he talked about splitting Walmart stock. And he talked about it in the sense that if employees are going to be buying stock, they're going to be wanting to buy whole shares of stock. Now, at that period of time, in the 70s, 80s, 90s, it was much more costly to trade stocks, and trading fractional shares was not as common and as possible as today. So today you can go in and you can say, hey, I want to buy $25 of NVIDIA stock. And the brokerage will handle that for you. There will be no problem with that at all. That wasn't the case when I started investing in the early 90s. Trading fees were much higher. They were about $25. And if you wanted to buy $25 worth of stock, you just weren't going to be able to get that because you needed to buy at least one share at a time. There was often fees that went along with how many shares you bought as well. So there was mechanical reasons for this to happen in the past. A lot of those reasons no longer really exist in the digital market that we have today. But that doesn't mean that investors don't psychologically feel like it feels better to own 10 shares of NVIDIA stock than it does to own one share of NVIDIA stock. But there's also a reason from a market making perspective where having a lower price does make a lot of sense and does actually give trading a little bit more liquidity. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Liquidity in the market is often provided by people that are called market makers. So these are the people that you are going to either buy or sell a share of stock to, depending on what you want to do. So let's say that a stock trades for $100 per share. What they're going to say is they will sell you that stock for $100 per share, but they will buy it for $99.99. They're going to make a penny spread. It's called the bid-ask spread. It may seem really small, but if you're making thousands, maybe even millions of trades every single day, those pennies add up. And that's how those market makers make money. There's market makers for everything, from stocks to bonds to options. Every time you make a trade, there is someone on the other side of that trade, and that someone is probably a market maker because they're just the connective tissue providing what we call liquidity, or a group of buyers and sellers for stocks. Now, if you're providing liquidity, oftentimes what you're really providing is not just one share or two shares of liquidity. You're providing what they call round lots, or 100 share lots of liquidity. So you're just going to say that stock that's trading for $100 per share, I will buy 200 shares at $99.99. I'll buy 1,000 shares at $99.98. And that's kind of how the liquidity pool works. And there's kind of a normal distribution right around the range that the stock is trading. That's why if a big order comes in, it can move a stock up or down really quickly just because it eats up all of that liquidity. Now, if a stock is trading for $1,000 per share and you need to put up 100 share lots, that's $100,000 on every single trade. That is a lot of money even for market makers. So reducing your stock price down to $100 per share means that you only need to put up $10,000 per trade. Lowering it even further to something like $10 per share means that it's only $1,000 to start to create a market with round 100 share lots. These are the mechanics. And so when they talk about liquidity being a piece of the puzzle with stock splits, that's exactly what they mean. Is that the people who are actually buying and selling stocks on a second-to-second basis and providing a constant buyer and seller in the market need to have the money to back those trades. And they're going to do that by providing constant liquidity. And it's cheaper for them to do that if the stock is at a lower price than it is at a higher price. So those are the mechanics behind the stock split. And that's why this does make a lot of sense. I know that a lot of companies resisted this for a lot of years, but now we're starting to see, especially these tech companies that used to like their really high stock prices, are now starting to go to a more traditional look at stock prices and where their companies should be valued. The old school way to look at it in the 80s and 90s was that you wanted your shares to be trading somewhere between $20 and maybe $80 per share. Now it's more like $50 to $200 a share is a little bit more normal. But these are just kind of the norms and psychological levels that investors and market makers look at. But hopefully this provided a little bit of context on why NVIDIA is splitting their stock. You don't actually own any more of the company, whether you own one share on June 7th or 10 shares on June 10th. But that doesn't mean that there won't be an impact on the stock and how it trades on the market. So what do you think about NVIDIA stock split? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.